US inflation is below forecasts. President Trump undoubles Canada tariffs, but imposes global steel and aluminium ones. Japanese bond yields hit their highest since 2008, thanks to safe haven demand. And New Zealand's heavy traffic got moving in February. That's coming up in our 5 Things in 5 Minutes on Wednesday, March the 13th. And then in today's bonus deep dive interview, ANZ Economist Dhiraj Nim looks at how India's growth rate over the next year may come in below potential, opening room for rate cuts.
We think that stars are aligning, that the Reserve Bank of India could actually push the monetary policy a little bolder than it has so far.
But first, in 5 and 5 with ANZ, US stocks have bounced somewhat overnight, reassured by lower than expected US inflation of 0.2% in February. 0.3% was expected. And there was some good news on tariffs, although it is a real roller coaster. Donald Trump yesterday undoubled his Canadian metals tariffs from 50% back to 25% after Ontario dropped threats to charge a surcharge on US-bound electricity. But as ANZ head of G3 Economics Brian Martin points out, the Trump administration's move to confirm 25% tariffs on global steel and aluminium imports is still increasing the risk of further retaliation, including from the EU. For now, markets took some solace.
That was also aided by comments from US Commerce Secretary Howard Lutnick that the US wants to de-escalate trade tensions with Canada, and also that if other countries reduce tariffs, then the US could possibly look at that too. So the tariff sentiment was a little bit better, but we know there's a lot of twists and turns in this virtually on a daily basis at the moment. So I would expect that financial markets are going to remain quite defensive, awaiting clarity following the US review of trade policy in early April.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.6%. The US dollar index was flat, as was the US dollar against the Canadian dollar after the Bank of Canada cut rates. The Aussie dollar was up 0.2% at 63.10 US cents. The Kiwi, about the same, up at 57.26 US cents. The yield on the 10-year US Treasury was up 3 basis points at 4.31%. And West Texas Intermediate Futures up 2.2% at $67.70 a barrel. And finally, gold up 0.8% at $2,938 an ounce. Number 2. ANZ Group Chief Economist Richard Yetzinger believes the market downturn being seen in the US could be a precursor to the Trump administration pivoting away from policies causing uncertainty.
I suspect the equity market will be part of the signalling that eventually gets some reassessment of the vigour with which Trump is pursuing his tariff policies and the efforts around DOGE to cut back government spending. It may also be the administration's own poll numbers. Maybe Trump's approval rating will be something. If that starts to shift, and it doesn't seem to have moved much so far, but if that starts to shift in the wrong direction, potentially that's something which would get the administration to rethink how vigorously they're moving on some of their policy areas and in fact the policy areas themselves.
Number 3. One benefactor of slumping US markets has been Japan, where government bond yields have risen to their highest level since 2008, and the yen has moved higher. ANZ FX analyst Felix Ryan says the Bank of Japan's governor yesterday implied that rising yields were a sign of increasing market views of the sustainability of Japanese inflation.
It does suggest that the sharp moves in yields aren't a concern for the time being for policymakers, really suggesting that all seems to be evolving comfortably with the Bank of Japan's rate outlook for the time being. And I guess those high yields will also offer some support for the yen as well, on top of the safe haven demand that we're seeing, just given the uncertainty around the US economic outlook and tariff policy, really adding to that haven appeal of the yen versus the US dollar for the time being as well.
Number 4. New Zealand heavy traffic movements, which provide a real-time signal for GDP, maintained January strength last month, according to the ANZ Truckometer Index. ANZ New Zealand Chief Economist Sharon Zollner says that's positive for sectors of the economy linked to heavy transport, but weakness in consumer-linked sectors is still evident.
Certainly, some sort of recovery is expected after that extreme weakness that we saw in the middle part of last year, and the similar sort of pattern is evident in the heavy traffic. The light traffic, on the other hand, is actually looking really flat year on year, in contrast with the trucks that are up nearly 5%. And that is actually, you'd have to characterise that as weak, given the population has grown substantially over the last 12 months. So that certainly is a reminder that although the economy has turned a corner, it isn't exactly racing away. People are still doing it pretty tough. A lot of people with mortgages have not yet rolled over onto the lower rates.
Number 5. Sharon says that while New Zealand's economy has turned from last year's recession, the next year still isn't going to look all that great.
We're anticipating GDP growth of only 1% this year, which in the context of an economy that fell 2% in 2 quarters last year. That's nothing flash, really. So it is a bit of a slog out of the recession, but with interest rates much, much lower than they were and expected to go lower yet. I think it's well understood that it was those higher interest rates that caused the recession. So lower interest rates should be a pretty effective cure if the economy is left alone to enjoy them. And of course, there are some pretty dark clouds gathering overseas at the moment.
Sharon Zollner there. Now, following yesterday's deep dive on India's inflation outlook, February's annual CPI inflation rate in India was 3.6%. That was below economists' forecasts and below the Reserve Bank of India's 4% target. In the second part of our deep dive, ANZ Economist Dhiraj Nim explains why a policy push is required during the next year to stop GDP growth dropping below its potential.
As of the recent GDP data, the rebound is of course welcome to 6.2%, but some of the key components of growth, such as manufacturing and investment, they have shown a bit of a slowdown. The revival in consumption growth seems to be led largely by rural recovery and is not across the board. And we are skeptical that agricultural growth can sustain above trend at about 5% for much longer. As base normalize, these growth rates will also normalize. So we think that in absence of a strong policy push, some of these tailwinds will soften and growth could start normalizing even more. And of course, then there is the headwinds to export outlook from a potential slowdown in global trade and the direct impact of levies if the US administration imposes higher import tariffs on Indian goods as well. So therefore, we think that in absence of a strong policy push, the risk is that growth could gravitate towards 6% in India in FY26.
So what are the transient factors to look through, in particular this cum effect?
For the last quarter of FY25, that is Jan to March FY25, there could be some transient factors supporting growth. One of them is, of course, the public spending uptick because the government did not spend a lot of money in the first half of the fiscal year. It is making up for the shortfall in the second half of the fiscal year, sort of artificially buoying growth in the last 2 quarters. But this is more like an intertemporal shift in momentum instead of a genuine fiscal push. So this has to be discounted when you're assessing the medium-term trajectory. At the same time, the Mahakumbh festival, which took place in January and February, actually warranted millions and millions of people to move to the state of Uttar Pradesh to take a dip in the holy river Ganges. But this festival falls once in every 144 years and is likely to show some buoyancy in indicators like railways and air travel, food production, local hospitality, and other services, etc. So while assessing the medium-term trajectory of growth for India, I think some of these factors will have to be discounted, and the high number, which is expected by the Ministry of Statistics at around 7.6% GDP growth in Q1 2025, will not actually be sustainable going into FY26.
So why should we watch wages in rural areas and two-wheeler sales?
So the rural recovery actually is quite visible in a number of indicators. For example, the agricultural GVA growth, which rose above 5% year on year, was actually surprising. Similarly, that possibly led to a revival in consumption growth rate to about 6.9% year on year as well. The fact is that some of the high frequency rural indicators, like the two-wheeler sales and real rural wages, are beginning to peter out. These mean that the fundamental drivers of consumption are not strong enough to sustain significant growth momentum going forward.
And which type of policy, fiscal or monetary, should be used to boost GDP growth from 6% towards that potential 6.5% to 7%?
As it so happens in India's macroeconomic configuration of today, the fiscal policy is tied rather strictly to the debt and deficit ratios. So we have an elevated public debt ratio. The fiscal deficit still needs to be brought down. So the government has committed fiscal deficit at 4.4% of GDP for FY26, which means that the spending pullback that will happen because of that deficit consolidation would actually be negative for growth. So all in all, the fiscal policy cannot really do much to support growth while remaining disciplined and adherent to its fiscal targets. The onus therefore lies on monetary policy, and we think that stars are aligning that the Reserve Bank of India could actually push the monetary policy a little bolder than it has so far.
Dhiraj Nim. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, March the 13th. Catch you tomorrow with more from Richard on what the Trump administration might pivot to if a change in economic policy is required. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.